The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled What to Know About Gift Taxes. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you very much, Amber. Welcome, everyone. Glad you joined us today for our webinar on gift taxes. I'd like to remind you that we put on this webinar every month. It is free of charge and open to all insurance and financial professionals who might be interested. We'll talk next month about starting the buy-sell conversation. As with all of our free webinars, they are held on the first Wednesday of the month. In April, it will be April 5th. They are held at 11 a.m. Central, so feel welcome to put it on your own calendars. Feel welcome to invite those that you think might be interested in the topic, starting the buy-sell conversation. Now, before we get started on gift taxes today, let's go ahead and decide what it is that we'll be presenting in May. You've got three choices. The first choice is trustees' obligation to irrevocable life insurance trust beneficiaries. The second choice will be stranger-owned life insurance gets spicy, Stoli gets spicy. And the third choice is reviewing the IRS's latest Dirty Dozen list. So I'm going to go ahead and open the poll and invite you to go ahead and vote for your topic choice for the May webinar. Give you another second to vote. Looks like everybody is voted, and next, May's topic will be reviewing the IRS's latest Dirty Dozen list. Thank you for voting, and that's what we'll talk about in May. So let's go ahead and get started on our webinar today. What to know about gift taxes. Here's what we're going to talk about. We're going to talk, first of all, about motivations that are behind family gifts. We'll spend just brief time on that. We'll talk about the tax basics associated with making gifts. We'll talk about the estate tax sunset rules and how they affect folks who are planning to make more sophisticated gifts or bigger gifts. We'll take a quick look at the gift tax tax return. And then finally, we'll touch on some of the considerations that people ought to think about in connection with irrevocable life insurance trusts. So let's go ahead and get started. First of all, let's talk about the motivations behind gifts. Why do people make family gifts? Well, first of all, obviously they'll make gifts to meet the needs of a family member. Somebody's got somebody in the family has a immediate financial crisis. Some in the older generation typically might be motivated to make gifts to that family member. People might consider making gifts right now, transfers as opposed to death time transfers for various reasons. One psychological reason might be that the giver is able to see the family member enjoy the money or the property that's passed along during lifetime, see the recipient enjoy that gift and get some pleasure out of that. And then one other reason that might motivate a family gift, and this list is certainly not comprehensive, but it's what we see as we talk to financial professionals. Gifts can be used as a way to manage the estate tax liability of the donor. So let's talk a little bit about the tax basics associated with making gifts. And from my perspective, one thing that we get asked about, Jennifer and I at Advanced Underwriting Consultants get asked about all the time is, does making a gift to a family member help with regard to income taxes? And the answer to that question is no. There's no direct interaction between making gifts and income taxes. And when I say no direct interaction, I mean that both positively and negatively. What do I mean by that? Well, there's no tax deduction. If I give stuff away to my daughter, for example, I get no income tax benefit today for having made that gift. And on the positive side, I suppose, from her perspective, if she receives that gift, she pays no income tax on it either. And so I get no tax benefit. She gets no tax liability as the recipient either. So there's no direct interaction. Well, why do I say direct interaction? And the answer is there can be indirect consequences. Again, in the example where I might make a gift to my daughter, if I hang on to money, for example, and I invest it, I will pay income tax on those investments as they produce taxable results at my tax bracket. Well, if I make a gift to my daughter instead, and she receives those gifts and invests the money and has taxable results, she will pay income tax at her tax bracket, and that tax bracket might be lower than mine. So that's the indirect effect on income taxes associated with making gifts, but there's no direct interaction on gift taxes. The gift tax rules, and they do exist, the gift tax rules are their own separate thing from income taxes. And there's a whole gift tax schedule. It's a graduated rate depending on the size of the gift. But as you can see, if people are making sizable gifts, the rate pretty swiftly goes up to 40% and stays there. Gifts of more than $1 million are subject to a 40% gift tax rate. So that's an important thing to know. So are all gifts subject to gift taxes? The answer is no. We've got some positive things in the gift tax rules that allow us to make gifts without having to worry about any gift tax consequences. And I think there are two important things to understand in the realm of gift taxes. The first is the gift tax annual exclusion and the gift tax and estate tax lifetime exemption. So let's talk about the exclusion first. So that's $17,000 in 2023, and the ability to use the annual exclusion renews every calendar year. So what does that mean? Well, what it means is I can give anybody that I want a gift of up to $17,000 in 2023 without having to worry about any gift tax consequences. So if I give 17 grand to my son, 17 grand to my daughter, 17 grand to the mail carrier, right? Because I like the mail carrier. I can give 17 grand to the neighbor. I can give 17 grand If I've got grandchildren, I can give 17 grand to each one of my grandkids. If I've got in-laws, I can give 17 grand to each one of my in-laws if I'm inclined to do it. So 17 grand per donor, per donee, per year. I can do that without having to worry about any kind of gift tax consequences at all. It doesn't eat into the exemption. It's just a freebie every year that renews every year. And it's a use it or lose it kind of thing. If I don't use it in a year, I don't get to carry over the fact that I didn't use it last year into this year. So annual exclusion amount, $17,000 per donor, per donee, per year. So what's the exemption amount? Well, the exemption amount is tied to the estate tax exemption. They are integrated with each other. You have probably heard that the estate tax exemption in 2023 is nearly $13 million. And the gift tax exemption integrates with that. Well, what does that mean? Well, if I make gifts in excess of the annual exclusion amount, I eat into my $13 million or so unified estate and gift tax exemption amount. So I'm able to use that exemption either while I'm alive or after I'm dead, or some combination of both. And so when people call us and ask us about making gifts to family members, they worry about making gifts in excess of the annual exclusion amount, the $17,000 that we talked about already. And what Jennifer and I talked to them about is that it's possible to make much bigger gifts than that. And the only consequences are that the extra gifts will eat into their lifetime exemption amounts. Well, how do we keep track of lifetime exemption amounts? Well, before we get into that, let's talk about sunsetting, right? The exemption amount is currently about $13 million, but those of you who have been paying attention know that the $13 million exemption is scheduled to sunset in the year 2026. And what does that look like? So the sunset, or the current exemption lasts through the end of 2025, not that long from now, 2.5+ years from now, and it's scheduled to return to the Obama era exemption of $5 million adjusted for inflation. The adjusted exemption amount in 2026 is projected to be between $6 and $7 million. Probably will be closer to $7 million because of the way inflation has hit in the last couple of years. And the maximum rate will increase from 40% today to 45% in 2026. And so we've got a short-term opportunity, and we'll talk about that in just a minute, to make bigger gifts if we've got really high net worth clients, to make bigger gifts between now and the end of 2025. So we'll talk about that in a second. Here's what I mean. So the IRS, and this is a direct quote from the IRS website, the IRS said, well, if people make big gifts now, and if the exemption ends up where they use all the exemption of about $13 million in 2023, what will happen when the exemption goes down to about $7 million in 2026 and somebody dies? Will the IRS try to retroactively collect tax based on the difference between what they used and what the exemption is in the future? And this quote from the IRS's website reinforces the idea that the IRS won't retroactively try to collect estate taxes on excess exemption amounts that were used prior to the reduction, right? Prior to a potential reduction in 2026. And so when you look at this quote and you see the BEA, they're talking about a prior exemption amount that might have been available. And so the IRS won't penalize people for making big gifts. And in fact, in a way, they're incentivizing people for using up the exemption fully at its current $13 million level because people won't be penalized for that. And so for your really high net worth people, they ought to be thinking about making big gifts before the change is scheduled to come into effect in 2026. So let's take a quick look at the gift tax return, and I'll show you that it's both simultaneously scary and not. It looks a lot like an income tax return. The style is the same, but the questions that are asked are a little bit different. A few things that I want to point out about this 2022 version of Form 709, the federal gift tax return, is that if husband and wife are joining together to make an annual exclusion gift, they'll want to file the gift tax return so that it's clear that both spouses are joining in the gift. I talked about earlier somebody making a gift in excess of the annual exclusion amount and dipping into their exemption. How is it that we keep track of that? Well, lines 7 through 9 here on the gift tax return is really how that's done. You're keeping track of the aggregate amount of gifts made during lifetime that have dipped in and used up part of the lifetime exemption amount, and this is how it's being kept track of, lines 7 through 9 on the form. Finally, on page 2, Schedule A of the form, you can see here in Part 1 that for hard to value assets, the IRS expects the donor to list the asset and to list a fair market value as of the date of the gift. And so if we've got an interest in a closely held business, for example, that is going on the gift tax return, the IRS expects the donor to come up with a fair market value, may require a formal valuation. There are penalties for understating the value of gifts on the gift tax return. One of the advantages of filing a gift tax return is that there's a deadline for the IRS to challenge those valuations if the return is filed. If the gift tax return is not filed where one is needed, then the IRS basically has until after the insured's death to challenge the value of the gift that the donor thought he was making to family members, right? So the gift tax return does potentially put an end time that is sooner to the IRS's ability to fight over the value of the gift. And that's one of the reasons why people should file gift tax returns during lifetime. But this is what the gift tax return looks like. If you've ever called us and we've told you that the only consequence of making a big gift is for the taxpayer to have to file a gift tax return, it's this form that they will be filing. So let's touch on irrevocable life insurance trust considerations, because I know a lot of people on this call are life insurance producers. From my perspective, there are a few issues that are relevant, especially relevant related to gift taxes in conjunction with ILIT planning. The first one is that if we are going to have the annual exclusion amount available to mask any tax consequences associated with making gifts to the trust, what we've got to do is put crummy provisions inside of the ILIT. That is the ability of the beneficiaries to withdraw money put into the irrevocable trust. Those provisions are needed to make the gift qualify for the annual exclusion amount. We get a lot of questions, Jennifer and I do, about the trustee not having followed proper crummy procedures in the past in connection with ILIT administration. And if the trustee hasn't, the risk is that the prior gifts will eat into the donor's lifetime exemption rather than qualifying for the annual exclusion. So in any event, that's why crummy provisions, withdrawal provisions, are usually built into irrevocable life insurance trusts. There are also more subtle gift tax issues if there are gifts inside the trust that are greater than $5,000 per year, which the beneficiaries decide not to withdraw. I'm not going to get into the details there. The issues are subtle and they can be managed potentially with proper trust language. I just pointed out to you so that you know that those issues exist. And if you see an irrevocable trust that has words in it about $5,000 or 5%, this is the subtle issue that they're dealing with inside the words of the trust. The more interesting issue, at least for today, is the possible gift of an existing life insurance policy into an irrevocable trust. Many of you already know that if you have an existing policy that you're transferring into an irrevocable trust, in most cases, the insured is going to have to survive that transfer by 3 years in order for the death proceeds to be excluded from the insured's taxable estate for estate tax purposes. Having said that, in a lot of cases, the insured will still be interested in transferring an existing policy to an irrevocable trust. When an existing policy is transferred to an irrevocable trust, coming up with a value of that policy for gift tax purposes can be kind of tricky. We do have regulations from the IRS that say how such policies are supposed to be valued, but those regulations aren't particularly helpful in a lot of circumstances. We have a pretty good idea that if the policy is transferred in its first year, the policy's value is equal to the first year's premium. We also have a pretty good idea that if the insured is reasonably healthy, the value of the policy for gift tax purposes is something called the interpolated terminal reserve plus the unearned premium. That's the good news. The bad news is that it takes an actuary to figure out what interpolated terminal reserve means. And so generally people are stuck with contacting the life insurance company and having an actuary calculate the ITR, the interpolated terminal reserve, so that they can get a good number for gift tax purposes. Where we've got a bit of an insurability problem for the insured, the regulations kind of hem and haw over how a policy ought to be valued. The regulations say something like interpolated terminal reserve plus unearned premium is to be used unless there's a better way to value the policy. Well, what does that mean? When is it that we've got a better way to value the policy? We don't have great answers from the IRS. I suppose one day, if the life settlement industry becomes a little bit more standardized than it is today, a little bit more consistent with the offers that it will give to insureds who are trying to sell their policies, the regulations might change to reflect what a life settlement company might offer for a policy, but that hasn't happened yet. And so that's what we've got in terms of regulations. So let's wrap this up before I turn it back over to Amber. So the takeaways are, first of all, the gift tax rules are kind of flexible. They open up a lot of planning opportunities. Secondly, life insurance can help leverage family gifts, right? Somebody who wants to make a gift to a family member might decide to make a gift of a life insurance policy that can provide a much bigger death benefit eventually. And life insurance obviously can help solve other problems. And then strategic gifting can help manage the estate tax exposures for some of our higher net worth clients. I'd like to thank you again for joining us today, and I'll turn the program back over to Amber to close us out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, April 5th at this same time. Next month's webinar will be titled Starting the Buy-Sell Conversation. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again and best wishes for continued success.